Okay, good afternoon and welcome back everyone to our monthly futures education session. My name is Tony Zhang. I'm the Chief Strategist here at OptionsPlay. I hope that this is a session that many of you are coming here for the first time to learn more about getting started with futures trading. Something that we haven't covered very often in the past, but this year we are launching monthly education on futures products. And today we're going to do a quick introduction to futures contracts. Last time we did a video about a month ago. There's a lot of feedback about going back to the basics, making sure that we cover futures contracts, how to go about getting started, different types of analysis. So today is really kind of a jumping off point for the rest of the year in terms of our futures education, giving you an overview of some of the topics that we'll be covering throughout the year and just helping you get started, especially since many of you answered some of the polls last time that you're relatively new to futures, you're just getting started. So let's go ahead and help you kick that off. Now, before we get started, what we are going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any of the specific securities or examples that we are going to use during today's session. So we'll start off by just taking a look at the futures contracts. I want to take a look at what futures contracts are and why I think they're advantageous in certain scenarios and why you should consider using them as an asset class for your portfolio. I do want to take some time and go through margin requirements because this is a benefit of futures. However, it is also a bit of a double-edged sword. So it's important to understand the benefits and also at the same time the limitations of margin and leverage and how you can use that responsibly in your trading. And then I want to talk to you about some of my trading strategies or strategies that you might deploy for trading futures, technical, fundamental, statistical, what they all mean, and some of the things that we're going to cover this year with respect to futures trading. Then I want to share with you some of my trading tips. Some of the rules that I had in place when I traded futures and how I utilize them in my trading nowadays when I'm trading some of the products that I'll show you here today. And I want to go through some of the products that the small exchange currently offers on hand and why I think they are advantageous for you as viewers here today. And I want to go through a live trading example to kind of highlight just why the small futures products are quite different and I think suited for our viewers here today. So the primary thing that I want everyone who's watching this session to be able to walk away from today is a clear understanding as to just how to get started with futures trading and answer some of your basic questions regarding futures contracts and how they generally work. So I'll start off by just kicking off by talking about, what is a futures contract? A futures contract is simply an agreement between two parties that allow both parties to assume the opposite side of the risk of an asset. So what does that mean? It means that there are different assets that you can trade futures contracts on, and there is a buyer and a seller to each futures contract. The buyer and the seller are taking opposite sides of the trade. The buyer believes that the asset is going to rise in value. The seller believes the asset is going to decline in value. And futures contracts span a pretty wide variety of contracts or wide variety of assets that you can trade futures on. And generally speaking, they span into two types or two categories. You have financial futures and you have commodity futures. And many of these, some of you may have heard of, or maybe some of you have traded some of these, but financial futures are indices, interest rates, currencies, crypto. These are the types of indice-based or financial-based futures contracts that you can trade. Now, many of you may not know, I started my derivatives trading career trading futures contracts, not options. I first learned how to trade futures. I was trading E-mini S&P futures, basically day trading the S&P 500. And I was doing this back in the day when in 2007, 2008, during the financial crisis, one, because there was a lot of volatility and opportunity in those products. And number two, at the time, I didn't have $25,000. So I couldn't day trade stocks. I couldn't day trade other markets. So futures was one of the few products that I could day trade with my account at the time that was under $25,000. So this is really one of the main advantages to futures, especially anyone who's watching this today. If you have a trading account under $25,000, you're subject to the pattern day trading rule when you're trading equities. When you're trading futures, you don't have those rules. So you can day trade very actively. And that's how I started my trading career. And then you have commodity-based futures. This is for commodities that you're familiar with: oil, gold, silver, precious metals, agriculture, hog cattle, those types of products that you can trade that are commodity types. So those are the general two types of products that you will be able to find futures contracts on. And these contracts allow you to speculate or hedge the rise or fall of these types of financial products or commodities in the markets. Does that make sense, everyone? Please type 1 into the chat window if that makes sense to you as far as what is a futures contract. And I'll go through some real examples here today so that you'll hopefully understand what I'm referring to. Okay, so I want to talk a little bit about how I think futures are advantageous before we dive into kind of the intricate details of a futures contract, because I want viewers to understand why we're even here. Why should you even take the time to learn more about futures contracts? So first of all, they are capital efficient. What that means is that they typically require only 1 to 25% of the actual contract size in terms of margin that you need to enter the contract. So if you want to buy $10,000 worth of a stock, you would need $10,000 of cash in order to buy those $10,000 of stock. But when you're trading a futures contract, you don't need $10,000. You can control that same $10,000 contract for a fraction of the capital. So you can be fairly efficient with your capital, and you can deploy the rest of that capital of that $10,000 somewhere else. Now, this is useful from a capital efficiency perspective. This is also a bit of a double-edged sword, and I want to come back and address this margin requirement aspect in a little bit. But first, just understand that you don't need to have all the capital to control a larger contract size. The second part, which I think is probably the most advantageous for a retail trader, is the fact that you can take long or short exposure equally. You have the equal ability to take a long or short exposure. Imagine, especially these days, where you think the markets are going to decline in value. As a stock investor, there's not much you can do. You can move into cash and try to protect yourself and hope to buy at a later time. But what if you wanted to profit from the decline of an asset? Maybe you thought oil was going to head lower. Maybe you thought gold was going to head lower, or the US dollar, or interest rates, or any of these products that you think are heading lower, Bitcoin, whatever the products are. If you're an equities investor, you don't really have a great way to short these products, certainly not without a lot of risk, without a lot of margin requirements, or just simply very expensive to short these products using option derivatives. So futures give you the ability to take a long or short position equally in these products. And lastly, like I said, they come without pattern day trading rules. So if you're trading these actively and you have a small account, this is a product that allows you to trade actively. There are also potential tax advantages. Futures are traded for those of you that are trading futures in a taxable account, are taxed at 60% long-term capital gains, 40% short-term capital gains. So if you were taking the same type of exposure using an equity-based product or a futures product, you can potentially have some tax advantage there. And also you have a wide selection of asset classes when you're trading futures. There are many ETFs these days. We have thousands of ETFs that are listed, and they cover a pretty wide variety of exposures that you're looking for. But when it comes to commodity type stuff, when it comes to interest rates, when it comes to some of the cryptocurrencies, equities doesn't provide, in my opinion, some of the direct exposure that futures contracts provide. So these are, in my opinion, some of the advantages that I see, or some of the differences, if you will, that futures contracts provide that ETFs or some of the other products simply do not provide. Does that make sense? Please type 2 into the chat window if that makes sense to you. And hopefully this kind of just illuminates as to why this is an asset class worth at least exploring and learning more about as you developed as a trader, giving you more opportunities to gain exposure to things in the market that you think are going to move, and the ability to potentially profit from that. And futures contracts provide you with that opportunity. So let's now talk a little bit about futures contracts, right? Because with option contracts, there's things that you need to learn. Same thing with futures contracts, but I will say futures contracts are much simpler to understand than options contracts, simply because trading futures is much more similar to buying and selling stocks than they are trading an options contract. But futures contracts do have certain specifications that you need to understand before you start trading them. First of all, there's a contract size. The contract size of a futures contract simply tells you the multiplier of the asset's price. Now, most of you watching this today are familiar with trading options, and you know options have a 100 multiplier. So depending on the futures products that you're trading, if you're trading on some of the CME-based products, there are all types of crazy multipliers. 5,000 barrels of oil, I think it's 2,500 bushels of corn, 62,500 British pounds. They're all over the place in terms of the multiplier. And I want to show you some of the differences between the small exchange and the CME-based products and just how they standardize things and make things a little easier to remember. So contract size simply tells you the multiplier of the asset's price. So if oil is at $80 and you have a 100 multiplier on that, you take 80 multiplied by 100, that gives you the contract size that you're trading. The second thing you have similar to options is an expiration date. And if you look at the CME-based products or traditional futures products, what you have are expiration dates that are all over the place depending on what products you're trading. They're literally sprinkled across the entire month depending on the type of contracts that you're trading. The small exchange also standardizes this because most options traders are used to the third Friday of the month being the expiration Friday, at least for the monthly contracts. Small exchange follows that same principle. So if you're an options trader, the transition to trading futures contracts with the small exchange is quite simple. And lastly, tick size. Futures contracts also specify the smallest amount that asset price will fluctuate by, and different products have different tick sizes. You'd be surprised at just how different tick sizes there are for different products. Some trade at a quarter of a penny, some trade at a penny, some trade at 1/2 of 1/32. They're all over the place with respect to traditional futures. The small exchange has also standardized this. So these are some of the things that you have to understand and know specific to the different contracts that you're trading. So unlike when you're trading, GLD or TLT or USO, when you're trading an option, you know that they're standardized across all those products. If you're trading an oil future versus a gold future versus a interest rate future, they have different contract sizes, different expiration dates, and different tick sizes. And that really makes the learning curve just that much more challenging. Imagine learning a new asset class and then having to learn a brand new expiration date, contract size, tick size for every new product that you trade. It just becomes a little bit more difficult. Not impossible, but even for traders like myself that have spent years trading these products, I still have to look up some of these things for the products that I'm trading. And that's really what makes it sometimes difficult to get started. So I want to show you a different way, a better way to trade these futures products. So what I do want to spend some time on is talking about margin requirements, because this is really what throws off new traders when it comes to futures, because there's a margin requirement in order to get into the contract. It's a fraction of the contract size that you are trading to enter the trade. And you can think of this as two different ways, right? You can think of it, one, as capital efficiency. So even though I have $10,000 in my account and I'm trading a $10,000 contract, I actually don't need to take all $10,000 and use it for keeping this contract open. I might only need a fraction of that. Maybe I only need $1,000 to open this contract, and I can still have the $9,000 left in my portfolio to do something else with it. Maybe I might buy some ETFs, or maybe I might put it in some bonds and earn some yield on that. You have flexibility. That's what the capital efficiency of margins provides you with. But this is also potentially a double-edged sword, because with a $10,000 account, you can potentially control a $30, $40, $50, or even maybe $100,000 position in your portfolio, and you are taking on the risk of that huge contract size. So you really have to think of it as two different, two sides of the coin, and you have to understand both sides before, in my opinion, you can responsibly trade futures. So when you think about capital efficiency, this is really, pulling a larger contract with a smaller amount of capital, and each contract that you enter has both initial and overnight or maintenance margin. So what that means is that you have to know how much capital do you need to open the contract and how much capital do you need every single day to keep holding onto that contract. And the gains and losses that you have on the full contract. So let's say you have $10,000 account and you're controlling a $20,000 contract, you are going to be responsible for the profits and losses of the full contract value. So if you have a $20,000 contract, the changes in the asset's price on the $20,000 contract, that is what's going to be debited and credited out of your account every single day. This is a process that we call mark to market. This is not something we generally have in other markets. I mean, you do have margin if you're trading on margin equities, but effectively we are recalculating how much profits and losses you have on the full contract and making sure that you have enough margin to continue holding on to this contract. And that process happens intraday and happens at the end of the day to make sure that you have enough a margin or enough assets in your portfolio in order to hold on to this contract. And if you don't have enough assets, you do risk liquidation. And that's a double-edged sword aspect of leverage. And just keep in mind, just because you have access to leverage does not mean you have to use it. Meaning, if you have a $100,000 portfolio, you might be able to access $200,000, $300,000, $400,000 contracts, but it doesn't mean that you should use it. You have access to it for some investors who are willing to take on more risk. You have access to that leverage, but keep in mind, leverage does not mean that you have to use it. And I think this is something that sometimes confuses beginners when it comes to futures. You know that a futures contract requires a small sliver of a contract value to get into it. And just because you have access to leverage does not mean you have to use it. So remember, leverage can increase both potential rewards and also at the same time potential risks. So understand that it's a double-edged sword. If you're going to increase your potential rewards, you're also at the same time going to increase your risk. And you're going to, and if the losses of the full contract exceed the account value that you have in your portfolio, that's when you are at risk of liquidation of the contract, meaning you will be forced to either buy or sell the contract to exit the agreement, and you would be left with a relatively small chunk of your portfolio left. So I want to talk a little bit about some of the rules around trading with leverage with respect to futures contract. But does that make sense between what I mean in terms of margin and leverage? If that does, please type 3 into the chat window. In terms of understanding margin and leverage. Okay, perfect. So let's talk a little bit about this concept of long-short exposure, because again, this is one of the main benefits, if you will, of a futures contract, because as an equity investor, largely what you're looking for are assets that you think are going to rise in value, and you're hoping to buy low and sell high. Yes, you can short stocks, and yes, you can short ETFs, and you can buy puts on using options. But all of those products, one, are quite expensive to go about doing so. It's not that you require margin in terms of margin interest in order to borrow a stock and short that stock. It's not particularly easy, I think, for every retail investor to short an asset. Yet, these days we might have a lot of assets that we think are going to decline in value. Maybe you think Bitcoin's going to continue declining. Maybe you think the equity markets are going to continue declining. As an equity investor, there aren't straightforward ways to profit from that. And this is really where futures contracts provides you with the difference, because future contracts give you true long-short exposure. You can either be the buyer of a futures contract or you can be the seller of a futures contract. And if you're a buyer, you believe the equity or the asset is going to rise in value. If you're shorting the futures contract, you believe the asset is going to fall in value. And it's a symmetrical exposure, right? Unlike options where you have to figure out the delta and that calculates your profits and losses. This is dollar for dollar. If something moves up by $1 and you have 100 multiplier, that's $100 gain. If it goes down by $1, you lose $100. So it's really easy to calculate your potential risk and rewards. And it doesn't require any additional capital to take a short position than it does to take a long position. You don't have to borrow the stock. You don't have to pay margin interest in order to short an asset. And this really gives you flexibility, regardless of what your views are for any asset class or any asset that you want to trade futures on. And most importantly, especially for those of you that have a small account, trading frequency, something that small accounts complain about all the time, pattern day trading rules. If you have under $25,000, you can't trade more than 4-day trades in a 5-day rolling period. It's a pain in the but for some of you with small accounts and you want to trade more actively, futures contracts allow you to trade as actively as you want, regardless of your account size. So if you're day trading equity markets, you want to day trade some of the crypto assets, interest rates, this is all available to you through futures contract. Does that make sense? Please type 4 into the chat window if that makes sense to you. Perfect. Okay, so let's talk a little bit about strategies, right? Because this is really some of the questions that I get most frequently, and it's probably, you know, the $1 million question when it comes to futures trading. How do you determine what do you buy, what do you sell? So I will tell you, you know, I started my trading career trading S&P E-mini futures. This is heavily focused on day trading. Most of the trades that I was, that I took, I was in for maybe 2 to 10 minutes at a time. You know, these are really scalping those small fluctuations in the market, taking, you know, 8 to 10 ticks, which is, you know, two and a half points on the S&P. You know, really scalping small amounts. And the only way to do that is to use technical analysis. And, you know, technical analysis, for those of you that are familiar with my style of trading and my analysis, you know, you're familiar that technical analysis is at the core of the work that I do. And I really love technical analysis because the same method of analysis that I apply to a 1 minute chart, I can apply to a 1 day chart, to a 1 week chart, and I can use the same form of analysis to look at equities, interest rates, commodities. And we all know that these days, when it comes to equities, at least, interest rates are a heavy factor in the direction of the overall broader equity market. So how do you look at interest rates? Well, that's really where I apply the same technical analysis techniques that I apply to the equity markets, I apply to the bond market or the interest rate market to give me a better sense for where perhaps bonds are heading, where perhaps interest rates are heading, because that's going to help inform my broader picture when it comes to equities as well. So that's part of why I use technical analysis very heavily in my trading, because of the adaptability to different time frames and the ability to look at multiple markets that largely ultimately have influence on the assets that I'm trading. Okay, so I'm actually going to be doing some education this year in 2022 specifically on each of these 3 forms of analysis: how I apply technical analysis to futures trading, how I apply statistical analysis to certain forms of futures trading, because there are certain products within, or certain asset classes, that are what we call mean reverting, and currencies, generally speaking, fall into this category, and interest rates generally fall into this category. Meaning, currencies don't trend, you know, in one general direction the way that equities do. They tend to be mean reverting, and many commodities are also mean reverting as well. So what we do use is actually more statistical based analysis. When something effectively is too far away from the mean, our expectation is they're going to come back to the mean. So statistical analysis is something that is typically used for certain futures products or certain assets that tend to rotate around one average price. And then lastly, you have fundamental analysis. Fundamental analysis is generally speaking more so for the commodity-based products. If you think about oil, you think about precious metals, these are heavily driven by supply and demand of these goods. So looking at some of the fundamental factors, looking at how much oil OPEC is pumping, look at how much demand there is for oil. These are fundamental factors that can help influence your views on where commodity prices are headed. So we're going to cover all of these 3 strategies in this year's futures education, talking to you about different strategies that you can deploy for these individual products. But that just gives you a sense for the different types or different techniques that you can apply to determining what assets should you buy and sell, and what directional view you might employ for these asset using futures contracts. Does that make sense? Please type 5 into the chat window if that makes sense to you. Perfect. Okay, so I want to talk to you a little bit about some of the rules for trading futures. Now, this is getting a little bit ahead of ourselves from the perspective of, if you've never traded a futures contract before, you're going to have a few other things set up before you can get here. And I'm going to show you how to get started with futures contract. But let's say you're starting with your futures trading. I have a few rules in place, and these are the rules that I had in place. When I was day trading futures, these are the things that you really have to learn in order to be successful at trading futures actively. And I will say, if you follow these rules, that does not by any means guarantee success. But if you do not follow these rules, I can almost guarantee that you will see losses from trading futures. And I've been doing this for the past 16 years. I learned how to do it myself. I taught a lot of people at the time how to trade futures contracts. And I've made it my career to help investors learn how to trade. So these are some of the rules that I had in place. And these are some of the rules that I think that without them, it's almost impossible to succeed in trading. And it doesn't just apply to futures. A lot of these rules apply to other markets as well, but it's very good for futures trading. Number one, you need to plan your entries and exits before you enter a trade. Just for an example, when I used to trade futures, the second I entered an order, the stop loss and take profit orders were automatically entered on my behalf. I had bracket orders set up automatically every time I entered long or short the markets so that I knew exactly where I was going to get out and where I was going to get in. And every single time that my limits and my stops were set at a certain distance away from the market. I never deviated from that. So it's important to have a plan when you place your trade. And it's good from my perspective to know before you enter the trade where you are going to exit. The second rule I had in place was never, ever move your stops. Ever, and some of you may have, you've probably done this when you've traded stocks, where you bought a stock at $19 and maybe you put a stop loss order at 17, and the stock starts to trend down, it gets closer to 17. You're thinking to yourself, yes, it's getting close to my stops, but I think that, it's going to rise back up and I don't want to get stopped out. So maybe I'll move my stops down to $16, just to prevent my order from getting stopped out. I think it might reach 17 or maybe a little bit 17, and then it's going to rise. And guess what happens? Sometimes that works, but most of the time the stock keeps declining. And now, even though you only intended to risk $2 a share, now you're risking $3 a share, $4 a share. We've all done it. It's not a good practice. And this is really where planning your trade ahead makes a lot of sense, because it helps you just stick to your rules. So never move your stops unless you're moving your stops tighter, meaning you're reducing the overall risk on your trade. So you entered the trade at 19, you originally had a stop at 17, and now the stock has taken off. So now what you do is you move your stops from $17 to $18, or maybe even up to $19, so that you take on no more risk on the trade. So if the stock keeps moving higher, you're moving your stops higher. That is the only time you should be moving your stops. Number three, never risk more than 2% of your total account value on a single trade. That means if you have if you get stopped out on a trade, the loss that you have on that stop should not exceed 2% of your total account value on that trade. And lastly, never ever add to a losing position. So when you buy something at 19, it declines to 17, and you're thinking to yourself, let me double down and hope that if it gets back to 18, I'll get myself back to break even. That is a huge no-no. This is the start. This is a slippery slope. And when you go down that slippery slope, many times this is really where I see some of the biggest losses in clients' portfolios as a result of this type of behavior. Now, for those of you that have been following me for a while, this is not new. This is probably something that you've heard me talk about over and over again. But for some of you, if you've never watched some of my videos before, these are some of the rules that I think you need to apply, regardless of the asset class that you're trading, but especially if you're day trading. This type of discipline is what's necessary to succeed. And I can almost guarantee that if you don't follow this, you will likely see losses from your futures trading account. Does that make sense? Please type 6 into the chat window if that makes sense to you. Perfect. Okay, so now we've talked a lot about kind of futures contracts, the benefit of futures contracts. Let's now talk about some specific futures products that you can trade. And this is really where I want to spend some time talking to you about the small exchange. This is a new futures exchange that's launched a few years ago from Tom Sosnoff and the folks at the small exchange. and Tastyworks. And I want to talk to you through their ethos, because I really think that for retail traders that are looking to get started with futures, the standard and simple ethos that the small exchange has really resonates with the overcoming some of the challenges that I think retail traders really have with futures contracts. Number one, most traditional futures contracts are way too large. If you look at the E-mini S&P 500, it's $12.50 per tick. So each point that the S&P 500 moves is $50 in profits or losses. So if the markets swing 20 points in a day, and we've seen significantly larger than that, you're talking about potentially over $1,000 of risk from a single contract. So they're huge. They're huge for retail traders. So the small exchange, their main ethos is to create futures products that are extremely small in size for retail. This means that you can get started and try out these products while risking very small amounts of capital per day. So if you trade a single contract in many of these products, you might see exposure of $20, $30, $40 in profits or losses in a day in a single contract. That's much more manageable for someone who's starting out to get their feet wet with something small. And that's really important. That doesn't exist anywhere else. The second part, standard. As I was telling you before, contract size, expiration date, tick size. Traditional futures have these three contract specifications all over the place. And I just look up corn futures, oil futures, British pound futures. They all have very different contract specifications. So each one that you're trading, use a brand new learning curve to that. With the small exchange, everything's standardized. Multipliers are 100, just like for those of you that are used to trading options. They expire on the third Friday of every single month, just like your monthly options expiration, with the exception of oil futures. And then they are all $1 a tick, meaning for every tick that the asset class moves by, you are going to see $1 in potential gains or losses. So much easier to understand and much easier to calculate your potential profits and losses. And lastly, they're just simple. And I'll go through a real example here to show you why they are much simpler, in my opinion, than trading traditional futures in what I consider as one of the most innovative products that I've seen out of the futures market in quite some time, especially in my 16 years of trading. I think this is one of the most innovative products that I want to show you. But the small exchange futures products are traded from 8 a.m. to 5 p.m. Eastern. So for those of you that are options traders, you're used to 9:30 to 4. This extends your trading window by about 2.5 hours, about an hour and a half in the morning and an extra hour here in the afternoon. So the futures products really allow you to get access to a wide variety of assets. You have equity-based futures products. You have the US dollar. Some of you, you trade, are familiar with DXY, the index, but there isn't a great product to actually get exposure to DXY. The US dollar futures allow you to do that. There's precious metals for gold, silver, and platinum. And then I think what I want to spend some time today is talking through the 2-year, the 10-year, and the 30-year yields. Those are the ones that I think are most innovative compared to what traditional futures currently provide. There's also US crude, small cannabis, and also a new cryptocurrency futures product. But I will say there are some new products coming down the line. There are options on futures that are coming. These are some of the things that I'm really excited to announce here in 2020 as we go through the year and some of these products launch. I'll be giving you exposure and walking you through some of these examples, but there are a lot more innovative products coming down the line that'll give you exposure to different asset classes. But today, what I want to spend some time is talking through one specific example that I think really highlights why the small exchange products are worth your time when it comes to gaining exposure using a futures contract. And I want to use a simple example, an example that I think we're all looking at these days in the market, which is the 10-year yield. Especially if you're an equity trader, you're probably glued to the 10-year yield. When that thing starts to tick up, you're concerned that your portfolio is going to decline in value, or vice versa. If the treasury yield starts to decline, you think it's time to buy the dip, right? So 10-year yields is something that we all as equity traders have our eyes glued to. Yet, how do we potentially profit or trade the interest rates moves? And sometimes as an equity trader, maybe we want to hedge our equity portfolio against that by basically saying, if interest rates go up, I want to profit from that. Or maybe I think interest rates are going to continue to go up and I know that's going to squeeze my equity portfolio. So how do I hedge some of those downside risks? Well, let's take one simple thesis, right? The 10-year yield. Currently, the 10-year yield is currently at a 1.81%. Let's say I think over the next month, this is going to rise to 2%. Maybe you think the Fed's on track. They're going to start raising interest rates here this year. So let's bet that interest rates are going to go higher. So what I want to talk through are kind of how can you go about doing that? And I'm going to skip over the equity side because I will say, for those of you that follow me on CNBC, you know that we've tried all different types of equity-based products to quote unquote trade interest rates. We've used XLF, we use KRE, we've used TLT, we've used even some of the emerging market currencies, emerging market ETFs that have some amount of sensitivity to 10-year yields. But none of those are a direct trade on interest rates. There's only there's only one way or two ways with traditional futures or futures products that you can bet on or trade the interest rate itself. Now, one, you can trade the bond futures because interest rates are calculated off of bond prices. So when you think about traditional futures, the ZB bond listed on the CME is the 10-year bond. And these futures products allow you to trade the interest rate or get exposure to the interest rate. But the problem here are a few-fold. One, the ZB bond is quoted in very odd terms. It's quoted in 1/2 of 1/32 of the bond price. So this is quite confusing. So when you see 127 spot 20, that really means it's 127 and 20/32. So just right off the bat, really confusing for most traders to think that still things quoted in fractions and not in decimals, okay? So not easy to just understand. Second of all, it's a contract size of $100,000. That's a notional value of a 10-year bond. So you're trading fairly substantial. And many of us are not looking to take on exposure on interest rates at $100,000 at a time. The margin requirement, granted, you don't need $100,000. You need $3,500 to enter one of these contracts. Not a huge percentage, but certainly not a small chunk of change to get into that particular trade. But the most difficult part that I have trouble wrapping my head around is that if I'm right on my view that interest rates are going to rise from 1.81%, right? I think it's going to rise from 81% to 2%. How much money do I make on shorting this future? The answer is I don't know. I have to do some calculations and I can make some estimations, but I don't know actually for sure how much I will actually on this bond future if I did short this bond future and the interest rates rose to the price that I wanted, because a bond is an inverse to the interest rate. So there are quite a few challenges, in my opinion, to take on direct exposure in interest rate that we all have our eyes glued on. So what I want to show you is some of the futures products that the small exchanges provided. The SY10 futures contract. The SY10 futures contract gives you direct exposure to the interest rate itself. So when the interest rate of the 10-year yield is currently at 1.81%, the SY10 future is trading at $18.10, a direct one-to-one correlation between the interest rate and where the futures are trading. So when you're trading a single futures contract on SY10 that's trading at $18.10, remember the multiplier is a standard 100 multiplier. So for every 1 cent that the interest rate moves by, I will make or lose $1 on my futures contract. Much easier to understand. They're quoted in 1 penny increments, just like the stocks and ETFs that you're used to trading. The contract size is 100 times the index value, similar to the option contracts that you're trading is 100 shares. And the margin requirement on this contract is $330, roughly 1/10 of the size of the ZB bond future. So if you have a small account, you can trade a much smaller contract, get much smaller exposure. You can have much more flexibility. So if you have a $10,000 account, maybe you're trading two or three contracts. You have a lot of choice as to how you want to scale in and out of your position versus with a $100,000 contract, you may not have any choice. You could either maybe trade one contract and that's it. You don't have the choice of trading a third of a contract or 2/3 of a contract. Here you have a lot more flexibility. And most importantly, if I'm correct, if interest rates rise from 1.8% to 2%, basically the futures value is going to go from $18. What $18? $18 to $20. So imagine buying 100 shares of an ETF that's currently trading at $18.10 and it rises to $20. How much do you potentially make on that trade? It's really easy to calculate that. It's $20 minus $18.10, which is $1.90. Multiply that by the number of shares that you have. If you have 100 shares, that's $190 in profits. And that's what the small futures allows you to do. So if you're correct on your view that goes from 1.81% to 2%, you'll make $190 per contract that you purchase of the SY10 future. It just makes this whole process of trading interest rates so easy. It's almost a no-brainer when you're thinking about trading these types of products as to whether you would trade the bond future or you would trade the interest rate future. This is one of the most active products that I've been participating on the small exchange just because of how easy this is compared to trading TLT. You know, for those of you that have been following me for years, I've been using TLT predominantly to trade interest rate views. And remember, TLT is a 20+ year bond ETF. It's not even the 10-year bond, but it's the most liquid equity product that we have access to, which is why we trade them. And we use options many times when we have a bearish view, which means that we have time premium that we're paying for. So there's a lot more complexity to trading TLT or shorting TLT using options than we have with trading interest rates that directly. Because if I think interest rates is going to rise, I have to figure out a way to short TLT. I have to buy puts, I have to sell call spreads. It gets a lot more complicated. This has been the way that I have been expressing my views in interest rates predominantly ever since I found out about these products versus trading TLT. So I hope that this illustrates to you just how different and how, what you can actually get from a futures product that you may not get with equities. That for the longest time, we've been using equities as a proxy, USO for oil prices, GLD for gold prices, TLT for bonds, maybe some of the Bitcoin ETFs for cryptocurrency. Well, with the futures contract, you can get direct exposure to the underlying that you need with a smaller amount of capital required, with a margin requirement, with the ability to long and short the contracts equally, and no pattern day trading rules with the tax advantage. So a lot of potential differences between trading equities and futures, and hopefully this illustrates to you some of those primary differences and helps kind of get you off onto the right track. So before we move on, I do want to ask the audience here for a poll of just to help me answer some questions. I'm curious, how many of you have traded a futures contract before? Do you have a trading account with either Tastyworks or IBKR? And if you're interested in finding out a little bit more about the small exchange futures products going forward, I'm just curious as to the audience here in this room. How many of you have traded futures before? Okay, about a quarter of you have traded futures, 30% of you have traded futures. So the vast majority of you here viewing this today have never traded a futures contract before. So I hope that this was helpful in just helping you get off on the right foot. Like I said, we have a lot more content in 2022 to help you with this. Every single month, I'm going to be coming back doing futures education on the Thursdays every single month. 30% of you say you have a Tastyworks account, 20 of you say you have an IBKR account. So that's about half of you have either a Tastyworks or IBKR account. Good news for those of you that have a Tasty and IBKR account is that you can enable small futures in your account if you enable futures trading. For the 50% of you that say that you don't have an IBKR or a Tastyworks account, I can show you today how to open one of these accounts and enable futures so that you can access the small exchange futures products. So it's great that half of you have access to these products, at least through your Tasty and IBKR account. And 94% of you say you'd like to find out more about this. Great. I'm really glad you said that. So let's just hopefully help you get started. Number one, if you want to find out more about the small exchange, you can go to this website here on my screen, which I will post into the chat window. And for those of you that are the 50% 90% of you that answered that you do not have a Tastyworks or IBKR account. There's a list of brokers, but in terms of the equity-based brokers, smallexchange.com/brokers will give you that list. But these IBKR and Tastyworks are the two that you can trade equities and small futures in one account with Tasty or IBKR. The important thing that you want to remember is not only do you need to have a Tasty and IBKR account, you also have to enable futures in those accounts and to find those small exchange products within your brokerage firm. So just remember, because you have those accounts, you still have to enable futures first before you can start trading. My suggestion to you is that if you have access, try to paper trade these to start with. But because the small exchange products are so small, I advocate investors who are starting out to trade a single contract, trade one of the small contracts, some live trading under your belt. That's how you're going to ultimately learn. That's how you end up building the discipline around the rules that I talked about, the 4 trading rules that I had. Trade live is really when you start honing that discipline. Trading paper trading, as much as you want to stick to the rules of paper trading, it's just not the same. And the small exchange really allow you to take small amounts of risk and kind of get your feet wet using the products that I showed you here today. And for those of you that are interested in setting up a Tastyworks account, OptionsPlay does have a special offer for you. You can open up your Tastyworks account at trade.optionsplay.com/tasty-small. And at this point, what I want to do is thank everyone for taking the time out here this afternoon. I hope that this was helpful in illuminating kind of how to get started with futures, because that was the feedback that we received on our last session, was that we didn't cover enough about how to get started. So hopefully this kind of gets you kicking off kind of how to go about getting started with futures. So at this point, I'll open this up for Q&A. If anyone has any questions, feel free to type your questions into the Q&A window, and I will try to answer as many questions as possible. Sure, I will do a session next time where we can compare some of the small to micro futures. From my perspective, the difference is the standardization, and when it comes to interest rates, this is really something that you don't have with those micro futures. Ash, there are actually options that are now going to be listed on the small exchange futures products. So you can potentially trade some of these strategies that you're referring to. I don't know that those are the best strategies for futures trading. Futures trading is far more speculative. When you're trading covered calls, those are on your long-term investments. So it's not. I wouldn't necessarily say that selling covered calls is necessarily the right strategy for trading. Ali, at the moment, I don't believe Tastyworks is available in Canada, but IBKR is available in Canada. So you would have to check with your broker as far as the cost for trading these, but you can go to the small exchange website and sign up for a community membership. It's a $100 lifetime subscription, which gives you half off on the exchange fees of these products. So if you're trading them fairly actively, the exchange fees are 15 cents a contract. You can have that if you buy a community membership. So if you find yourself trading these actively, you can get a discount on the cost to trade these. What is the ratio of treasury futures on SME to the yield? What is the ratio of treasury futures on SME to the yield? I'm not sure I understand the question, Tom. That you're trading the actual yield itself. So there is no ratio. You get 1-to-1 to the yield itself. I do not believe Tasty has a paper trading feature. They do. IBKR does, but I do not believe Tasty does. Is it always done as a day trading strategy? No, Julie, I've been using these interest rate products as a longer term view. I'm not day trading interest rates. I'm taking them usually swing trades. I'm looking at, I got long 10-year yields at around 170 basis points. My view is that it's going to head up to about 2%. So I'm holding on to these contracts. So it's not just for day trading. You can absolutely day trade these products, and a lot of people do. I would say more people day trade futures than longer term, but I just use them as a more direct exposure to longer term views that I have on interest rates. Tim says, I have extensive education on technicals. I only trade on technicals, not fundamentals. Am I going to be able to use my technicals for futures? Tom, 100%. I learn technicals on futures, and I apply what I've learned there now to equities and other products. Well, absolutely. The link, it's in the chat window. It's trade.optionsplay.com/tasty-small. I'll post the link into the chat window here again. Let's see. Richard, as far as your OCO order, bracket order with futures, that depends on your broker. The exchange certainly allows it, but that depends on your broker. How's the liquidity? So Shalom, I've been trading these, I enter my orders at the midpoint, and I've been able to see, fills near the midpoint or at the midpoint, usually many times within a few seconds. I'm not trading huge size, I will say. So if you're trading huge size, that's a different story. But usually these have been pretty tight in terms of bid-ask spreads, and I've been trading inside of the spreads with all of my orders. I never hit the bid or lift the offer, in my opinion. Sanjay is asking to demo placing a futures order. I will do my best to do that. I'm not set up at the moment to do that, but I will do my best, especially on the next session, especially on the technical analysis section. I will set up staging an order here for trading these products. I want to trade long-term bonds. What's the best way to start? Well, my suggestion to you is to use the 30-year treasury yield, because we think of bonds in terms of yield terms. So if you want to trade long-term bonds, I would use the 30-year treasury yield futures, in my opinion. That will allow you to trade the 30-year yield. We will not be doing daily plays on futures, but we will be doing swing trading on futures products, specifically the small exchange futures product this year. So we're launching that in the next couple of weeks. So I hope that for those of you that are interested in some of our trading signals on these products, that is something that we are launching here in a couple of weeks. Michael, that's a great question. I think the best way to kind of, there's been a lot of questions as to whether Schwab or Thinkorswim offers these. Currently, they do not. I do advocate, if you're interested in these products and you're at Thinkorswim, if you're at Schwab, go to your broker. Tell them you like these products. Tell them you want these products. And if you're not going to trade, you might move your account over somewhere else. That's the best way to get some of these brokerage firms to listen. You're the customer. They listen to the customer. So I do advocate, if you're trading at TD or Schwab and you want access to these futures products, let your reps know. You can't trade off the charts on Tasty, but you can trade off the quote that's on the chart. So, I trade right off the bid-ask quote on the chart. Does your futures contracts mess up the demand and supply of the products and therefore ethical? Jay, I will say that I don't think that your futures contracts will have any impact on the supply and demand of these products, because you are not influencing whether or not more people are going to go out there and get on an airplane, or how much oil the OPEC is going to pump. So no, I do not believe that the futures contracts will impact supply and demand. You do not need to have a brokerage account to use the paper trading feature on IBKR. Yes, will we be having sessions on technical analysis for futures? That's actually what I plan on covering for the month of February. So that's actually the next topic that we're going to be covering in February. There are no margin fees to hold on to a futures contract long term. You do have to roll these contracts every single month. So when they expire, you have to roll to the next month. But so there are roll costs involved in that, but there are no margin fees to hold on to a futures contract. Okay, those are that is the time that I have for questions. I just want to again thank everyone for taking the time out here this afternoon. I hope that this was helpful in giving you a start to futures trading, giving you that understanding of how to get started, what the basics are, and just kind of show you what we have in store for the rest of the year. Technical analysis, fundamental analysis, statistical analysis. We'll be covering specific products, especially as some of the new products launch here this year. Options are coming. Some of the cryptocurrencies are also coming this year. Really excited for some of those products and showing those to you. So with that, thank you so much for your time here this afternoon. We will send you both the slides and the recording after we finish here today, so that you can review these at your own pace. Thank you so much and have a great trading day, and I'll see you guys here next month. And for those of you that are joining me tomorrow morning, I'm hosting an AMA. You can ask me anything. Literally nothing is off the table, so please join me tomorrow morning for that. I'm really looking forward. Thank you so much and have a great night.